Hello, everybody, and welcome to Intermediate Accounting 17th edition solution walkthrough video. This is for problem 1512. This is from the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are mine, or Bennett Tchaikovsky, and not the authors of the textbook or Wiley. Okay. I want to say let's get the accounting part started. It's in the morning, so let's have some fun. Okay, let's go over here. So we've got analysis and classification of equity transactions. Okay, so it tells us the company was formed on July 1st, 2018. We have our shares authorized and giving us that information. And then ultimately it's asking us to prepare the stockholders equity section of the balance sheet, including the appropriate notes for Penn Company as of June 30th, 2021. So again, we're not having to do journal entry. So what I'm going to do is with most of the equity questions, I kind of like if I'm being asked to prepare a statement of shareholders equity, what I want to do is kind of keep a tally of the different items that are happening. And so this is one way to go through and to do it. So let's just go ahead and have some fun. So I know that from inception, I have 300,000 shares authorized, and the par value is $10 per share. You've heard me on other videos. You would never have a par value that's high, and just watch my other videos to understand why that is in fact the case. Then I have 100,000 shares, preferred shares authorized. And then this is going to be at basically $25 per share. Okay. So, again, if this was a publicly traded company, you would not see two classes of stock. But if you looked at, I just did a video on Snap, and let me just pause it real quick. So this is for Snap, also sometimes known as Snapchat. And I'm just going to kind of show you something that in the back of their filing, if we go through over here and take a look at it, if we take a look at their stockholders equity account, is that you're going to see over here. So this is before Snap was publicly traded. So here are their consolidated balance sheets. You see over here basically for their years ended. And then you kind of look down over here and you see that you'll see a ton of different preferred stock issuances. And, typically what's going to happen is once you become public, all of those preferred issuances are going to go away. What you will see is you will see common shares that have different voting rights. So that's something that you will see happening, such as over here, you've got non-voting, you've got voting. And before a company goes public, you'll oftentimes have like these different types of share classifications. And again, really, when you're dealing with this is really for you're essentially the investors generally dictate the terms. If I come over here and now look at the filing, a more recent filing of Snap. If I take a look at their balance sheet, all of a sudden now we're going to kind of see, oh, you're now just left with the non-voting stock, the voting stock, and then there you go, right? So that's how the shareholders equity works. Now that it's kind of grown up, the preferred shares have essentially gone away. They were more than likely retired, but that's how, for Snap, that's how you're kind of looking at what's happening. So let's go ahead and now take a look at, let's go back over here. Okay. So, and you would never have, just to kind of go through this point again, you would never have, oh, par value 0.0001. You have fractional par values because you do not want to sell if I sold this share to a shareholder for $10 a share, and then I sell it to a new shareholder for $8, the shareholder has a liability to the corporation to pay up another $2 to at least the par value. That's why the par value is always set lower. There you go. Enough of my ranting for the moment. So prior to the 2021 fiscal year, Penn had 110,000 shares of common stock outstanding, issued as follows. So 85,000 shares were issued for cash at $31 per share. Okay, so on 7/1/18, we had not a change of authorized, but we're issuing 85,000. That means that 85,000 are going to be outstanding. My par value per share was 10. So right over here, my par value that's being assigned to the shares is going to be 850,000, but I sold it for 31 per share. So what's going to happen here is that this is going to be 21 times the number of shares that I just issued. Let's change this to this. Okay, so let's just make sure that we did this correctly. So if I was doing this as a journal entry on 7/1/18, I'm getting cash of, this is 31 times 85,000, or 2,635,000. I'm crediting common stock at par. This is going to be for 10 times 85,000. And then the difference is going to go to additional paid-in capital common stock. Or, wow, 1,785,000. Okay. So let's go ahead and put this down over here. So that's how we came up with that first one happening. Okay, so on July 24th, 2018, 5,000 shares were exchanged for a plot of land, which cost the seller $70,000 in 2012 and had a fair value of $220,000. So in this case over here, my authorized aren't going to change unless there's a split. So in this case over here, I'm issuing 5,000 shares. So how do I go through and record it? Well, on 7/24/18, we're going to basically receive land. The land, we're going to basically show that at the fair value. Don't really care about what the seller paid for it. It's really going to be the fair value. So what I'm going to do now is assign a common stock at par. The common stock at par is going to be 5,000 shares times 10. Wow, I got a bad cell. Let's kind of make this. Okay, so the additional amount is going to go to additional paid-in capital common stock, or 170,000. Okay, so right over here, I'm issuing 5,000 shares. Par value per share is still at 10. So my common stock at par is going to be 50,000. And then over here, my additional paid-in capital will be 170,000. So that was essentially for that one of 7/24/18. So we'll just kind of park it down here. Okay. Now let's go to the next one. Number 3, 20,000 shares were issued on March 1st, 2019 for $42 per share. Okay, so right over here, I've got 20,000 shares were issued on March 1st, 2019 for $42 per share. So this is going to be straight up cash, common stock at par, additional paid-in capital common stock. So this is going to be 20,000 times 42. This over here is going to be a common stock at par. This is going to be 20,000 times 10. Difference is going to be going to additional paid-in capital common stock. Okay, so right over here, 3/1/19, issuing out 20,000 shares. Shares outstanding, I'm going to be adding another 20,000 to that. My common stock par per share is still going to be at 10. The amount that I'm putting over here to common stock at par is going to be, this is going to be 200,000. And then my additional paid-in capital common stock will be 640. And this transaction took place on 3/1/19. Let's go ahead and put this down below. Okay, let's go over here. So prior to the 2020-2021 fiscal year, and then during the 2020-2021 fiscal year, the following transactions took place. So I'm going to go ahead and assume that nothing happened. So we're going to go ahead and say 7/1/19, or as of 6/30/19, where were we? Okay, we've got 300,000 common shares authorized. We've now issued 110,000 shares. We have 110,000 shares outstanding. Our par value is still $10 per share. The amount that's gone to common stock at par is 1.1 million, which kind of makes sense. And then I've got the amount going to additional paid-in capital common stock. So during the 2020, so we had 110,000 shares prior to so we've dealt with this part here. Now, during the 2020-2021 fiscal year, I've got 11/30/20. So I'm going to assume that nothing happened over here on, basically, we'll just kind of leave this alone. So nothing else happened with common stock. So I purchased 2,000 of my own shares on the open market for $39 per share. So what happened on November 30th? Okay, when I go over here and I'm doing this, I'm going to debit treasury stock, crediting cash. So this is going to be 2,000 times 39, and that's going to give me 78,000. Okay, so when it comes to what I'm going to do here is I'm actually going to show the treasury shares next to the common stock, because that's what it's going to be impacting. Okay, so we're going to have treasury stock, and we'll have additional paid-in capital treasury stock. Okay, so with treasury stock, as we know from looking at my favorite company, the Depot, so right here, I go to my quarterly report, and when we see treasury stock in the owner's equity section, it's going to have a negative amount, right? Because when I record it, this is going to be showing as a debit. Treasury stock is an equity account. Typically, owner's equity accounts will have credit balances, right? The AELOE tells us all. So assets equals liabilities plus owner's equity. DC, right? So right over here, owner's equity typically have credit balances. So they'll have positive amounts when we're referring to it here. But when we have something like treasury stock, this is going to be showing up as a negative amount, hopefully with a date. Okay, here we go. Okay, so that's how we've gone through and showing this. So right over here. Now, the other impact that this is going to have is that when I purchased 2,000 shares of my own stock, this is basically going to be decreasing my shares outstanding by 2,000 shares. So my shares issued won't change, but over here, this down here will change. Okay. All right. Wow, and my other ones magically disappeared. Try to bring them back over here. Perfect. Okay. So let's take a look at the next one. So that's November 30th. Okay. So on December 15th, we declared a 5% stock dividend for stockholders of record on January 15th to be issued on January 31st. Penn was having a liquidity problem and could not afford a cash dividend at the time. Their common stock was selling at $52 per share on December 15th. Now, the first thing I'm going to tell you is there's a problem where you would not go through and do a stock dividend in this situation. And the reason is because once we bought back our own shares, you're not going to be able to pay yourself a dividend on that preferred stock. But I'm going to go ahead and just make sure that it's not for April 20th for me. So just give me a moment. Yeah, so by issuing a stock dividend, I have now effectively have diluted I'm basically diluting my own repurchase shares by 5%. So this doesn't make any business sense whatsoever, but we're going to go ahead and follow the book. So we've got over here, our shares outstanding are going to be 110,000 less basically this means the shares outstanding are going to be 108,000, which is 110,000 minus the 2,000 we just repurchased. Those are the outstanding shares. So my stock dividend percentage is at 5%. So the shares to issue are going to be 108,000 shares times 5% or 5,400 shares. When it comes to going through and doing to do a stock dividend, the way I'm going to go ahead and do it, it was declared a stock dividend. So we can say on 12, 15, 20, when I declare the stock dividend, I'm going to debit stock dividends, parentheses, retained earnings. This is going to be for 5,400 times the fair market value of the stock, or $52. Why is it that I'm using the fair market value? Is because it's essentially basically because over here, I'm doing this because the stock dividend is below, whatever the threat, it's either between 20 to 25%. So that's my stock dividend. We have common stock, distributable. This is going to be for the par value, or 54,000 times 10. So this is 52 times 5,400. This is 5,400 times 10. And then the difference is going to go to additional paid-in capital common stock. Okay, and then when it's the date of record, we don't care. When it's actually issued on 1/31/21, what I'm going to do is I'm going to have common stock dividend distributable, and then I'm going to have up here, this is going to become common stock at par. Okay. Okay. So in terms of how this goes through and impacts our financial statements, right over here is, whoa. Okay. So how does this go through and impact our financial statements? So let's just go ahead and we'll do it on we can basically just kind of combine these. So we'll say 1/31/21. So I'm now issuing out 5,400 shares. My issued shares are going to also be increasing by 5,400. My share authorized has not changed. My common stock per share. And so over here, my par is increasing by 54,000. My additional paid-in capital is increasing by 54,000. And then over here, when it comes to retained earnings, so over here for my retained earnings, this is going to be showing up as a negative amount for the amount of the stock dividend. or 208, 800. Okay, so let's move this down over here, and then let's take this party and move it down below. Okay. So that is our transaction so far on January 31st. Again, I'm combining the two for the stock dividend. Okay, on June 20th, I sold 500 of my own shares that I had purchased on November 30th for 21,000. So I'm reselling my treasury stock, but the question's being cute and it's not telling us what the price per share is. So we can't really determine if there's a gain or a loss, but we're going to go ahead and do that right now. So on June 20th, 21, I received cash of 21,000. Okay, so, but what I need to know is like, how much should I actually go through and pay for the share? So I'm going to credit treasury stock, and this is going to be for 500 at 39 or 19,500. So if I look at this over here, the difference would go to additional paid-in capital treasury stock. The additional paid-in capital treasury stock is going to be 1,500. Now, if I sold, so if I had 21,000 shares and this was 500, I sold this for $42 per share, or a profit of $3 per share. The 42 minus 39 is $3. I take the $3 and multiply it by the 500. Now, although I mistakenly said it's a profit, we never recognize a gain or loss when it comes to the selling of our own shares. So what I'm going to be doing instead is I'm just going to be hitting the treasury, or I'm going to basically be going through. So my treasury stock is increasing by 19.5. It's going to show as a positive amount. And then I'm going to have additional paid-in capital treasury stock. It's going to be up here at 1,500. So instead of showing a gain, I just put it into additional paid-in capital treasury stock. If I ever sold more stock, but I sold it at a loss, I would have first exhaust this and then put the rest to retained earnings. Okay, there we go. Isn't this fun, kids? Children, isn't this fun? I think it's a good time. Okay, so I'm right over here. Now we're getting into our next batch of preferred stock. So I issued on July 1st, 2019. And one other thing that I did is that my my shares outstanding are now going to be increasing by 500. When I sell the stock, I'm putting that back out into the open market. And so therefore, I'm going to be seeing my outstanding shares increase. Okay. So let's take a look at this one over here. So I sold on July 1st, issued 40,000 in preferred stock on July 1st for $44 per share. So if I were to go through and to do this, the way I would do this is I would say, okay, I'm getting cash. The cash I'm receiving is 40,000 at 44. I'm going to have preferred stock at par. My preferred stock at par is going to be 40,000 times 25, or $1 million. The difference going to additional paid-in capital preferred stock, or 760,000. Okay. I know you guys are going, Tchaikovsky, why don't you figure out the date stuff? And it's because I've got problems. And I'm not as good as Excel as you are. You're all phenomenal at Excel. I'm not that good. So let's go ahead and put this. So on July 1st, 2019, we had preferred shares. The authorized shares are not changing. We issued 40,000 shares, meaning we have 40,000 shares outstanding. My par value per share is 25. And so let's see here, per share. Oh, let's move this over. So my preferred stock at par, this is at $1 million. And then my additional paid-in capital preferred stock is going to be at 760. And this is going to be on July 1st. Okay. And let's just date this. So we 7/1/19. Okay, so let's put this down here. And now let's go back to the questions at hand. All right. So it says cash dividends. Okay, so Penn has the following schedule of declaring cash dividends in December and in June, with payment being made to stockholders of record in the following month. The cash dividends which have been declared since inception are shown below. No cash dividends were declared during 2021 due to the company's liquidity problems. Okay, and then over here, so let's take a look at the cash dividends. So on 12/15/19, in order for us to kind of go through and figure this out, how much did we have in terms of, and are there any kind of features on the preferred stock? So if I look at the preferred stock, it's 8%, $25 par value, cumulative and non-participating. So when we look at the amount over, so when we look at this in terms of $1 per share, if I take 25 bucks times 0.08, oh, it's doing it correctly. Okay, perfect. Okay. So, so they're doing this twice per year on the preferred stock. What was I just doing? Well, the preferred stock has a par value of $25 per share, and the dividend on it is 8%. So right over here, annually, it's going to pay $2. So over here, this kind of makes sense in terms of going through and doing this. So let's go ahead though, and let's deal with the preferred stock first. So Penn has the following schedule of declaring cash dividends in December and June. So we have preferred shares out? And the answer is yes. We had 40,000 shares outstanding. So the amount of the dividend that I would be paying on 12/15/19, so it's 40,000 preferred shares. So 40,000 preferred shares outstanding at $25 par value. This is giving me an amount of $1 million. So that's basically what I have. That's what the 8% is going to be subject to. So right over here, another way I could just do this to make it less complicated, if I'm paying the preferred stock at $1 per share, which might be the better way to do this. This is going to give me a preferred dividend on 12/15/19 of $40,000. So again, where did this come from? Another way to do it is you'd say, well, you've got $1 million, and then you multiply this by 8%. This is for the full year. And then if you're doing it in increments of semi-annually, then that's where they're getting the 40,000. So same thing. Okay. So what we would do is we would debit on 12/15/19. We would go ahead and debit preferred dividends. And we would be crediting cash ultimately for the 40,000. So this is when it was declared. So the other way of looking at this is saying that you've got over here, you could say, instead of saying 12/15, the actual payment is, and we don't really have to worry about cutoff because they're using a June 30th year end, but I'm essentially just going through and simplifying this. So you got 12/15/19, then we get 6/15/20. You're going to have essentially the same, basically the same entries, because over here, and then you're going to have 12/15/20. So on 12/15/20, you're also going to have preferred dividends, and then you're going to be basically be crediting cash. Now, what's interesting is that for the June, the payments being made as stock of record in the following month. So we would have a preferred dividend payable here if we were to go through and do this properly, but I think we're just more concerned with the amount of the preferred dividends. So over here, you've got basically another 40,000 coming through from the preferred dividends. And we'll just say 115.20, 715.20, and then over here you've got 12. This would be 115.21. Okay. So when I look at this over here now, no cash dividends were declared in June of 2021 because of the company's financial problems. So as far as dealing with, because these are cumulative, essentially when they pay dividends, it's going to, that obligation is going to carry over into the following, basically the following time. So again, let's go ahead now and put this in there. So for these dividends, let's go ahead and write this through. So we've got, and let's make us a little bit of room for ourselves. Okay. So let's go ahead and do 12, 15, 19 preferred. Let's add ourselves another row. We'll do 12, 15, 19 common. And then we're going to add um, 6, 15, 20 preferred, 6, 15, 20 common. And then in December of 20, or right around here, we're going to have 12, 15, 20 preferred. Okay. Okay. So this is just basically to denote the dividends. Okay, so for the preferred dividends, this is going to be directly impacting my retained earnings. So if I quickly hide this, not delete it. So over here for my retained earnings, this is going to be 40,000. This is also going to be 40,000. And this is also going to be 40,000. Okay. The common is going to be a little bit different, right? Because on our commons, when we have dividends, this is going to be based on these. So let's go ahead and move these down. So for the common shares outstanding, we're paying 30 cents per share. Now, the question becomes, though, is on December 15th, right? How many common shares did we have outstanding, right? So we're lucky because for us, the preferred stock sale was not done until later. So this happened after the issuance of basically the repurchase of the shares. So my dividends for common, my dividends for 12, 15, 19, and 6, 15, 20, my shares outstanding are 110,000. My dividend amount is going to be 30% of the 110,000. So here, what this is going to be is I'm going to go ahead and debit dividends. I'm going to credit cash. And again, I would do the kind of the same thing, 12, 15, 19, 1, 15, 20. And then this would be 6, 15, 20, 7, 15, 20. Okay. So over here, we've got 33,000 on each of these. And, again, you would be typically be doing on the date of declaration, you'd be doing dividends payable. I'm just combining it because of the question. Okay, so we've got 33 grand in dividends on these other days. So the 12, 15, 19 common dividend was 33,000. And then my common dividend on 6, 15, 20 was 33,000. Okay. Now let's go ahead and move this down. Okay. So this looks like a mess because it probably is. Okay. Well, let's go ahead now and take a look at what's next. So no cash dividends were declared in 2021. As of June 30th, 2020, retained earnings balance had a balance of 690,000. So as of June 30th, 2020, we had basically retained earnings was 690,000. And then for the fiscal year ended June 30th, 2021, they reported net income of 40 grand. Okay. So what I'm going to do really quickly is I just want to, I'm going to go through and just, I'm going to do, so what I'm going to do right now is this is the first time I'm doing this question. So hopefully we won't have to redo the video because I've just spent a lot of time going through and doing this, but if we have to, that's okay. So a few different things here is before I go down and start doing up my totals over here. I think what we can do pretty easily is that, we know that at the end of the day, the common shares authorized have not changed. It's still basically going to be at 300,000. My issued shares are going to be the 110 plus the shares from the stock dividend. My outstanding shares are going to be the 110,000 less the 2,000 that I repurchased plus the 54 that I issued as the stock dividend plus the 500 reissuance. My common stock per share hasn't changed. This is still going to be over here at 10 bucks. My common stock at par is going to be 1.1 million plus the 54,000. My additional paid-in capital common stock is going to be 2,595,000 plus 226,800. My treasury stock is going to be 78 plus the 19.5 for the reissuance. I've got additional paid-in capital treasury stock at 1,500. For my preferred shares, I've got 100 grand over here. I've got issued of 40, outstanding of 40. My preferred stock par value per share is at $25. This also has not changed. My preferred stock at par, and then over here, additional paid-in capital common stock is at 760. Now, I have to assume that when we were given the balance on June 30th, 2020, that this balance had taken into account all of these other transactions up above. So what our ending retained earnings balance would be 690 less the 40,000 preferred dividend, less the stock dividend, plus the $40,000 of net income of 409,200. So let me pause real quick and let's see if we're off or on. Okay, everybody, we did it correctly. So this is kind of exciting. So let's go ahead though, and just kind of a few different things. So when we do go ahead and do this, what you're going to notice is that the solution in the book, they do it a little bit differently, but I think it's more important that we are going to be showing the preferred first just because they will generally have liquidation rights. And we show things, they have liquidation rights over common shareholders. So we're going to list them out first. So what we'll do over here is we're going to have preferred stock. So the name of our company here, our company name is Penn Company. Balance sheet, partial, as of or 6/30/21. Okay, so our stockholders equity section. What we're going to have over here is we're going to have we'll start with preferred stock. We're going to have with our preferred stock, we're going to have if we were going through and doing this, we would want to say 8% cumulative and non-participating. We would then say 100,000 shares authorized. And then we would say 40,000 shares issued and outstanding. So that's what we would go through and say, preferred stock at par. And we'll call this preferred stock par. So this over here is going to be at $1 million. Okay, right then. The next thing we would show is we would do, and again, yeah, this is fine. We'll go common stock, par. This is going to be $10 par. This is going to be a $10 par value. 300,000 shares authorized. And then we're going to say 115,400 shares issued and 113,900 shares outstanding. Okay, right over here. Okay, so this over here is going to be 1,154,000. And your book shows that this is total, they'll call this total capital stock. As we see over here from Snap, and this is a company where their filings are being reviewed by attorneys and CPAs. So I don't think you need to show a total, but for us, I think it's good to see. So for our purposes, so over here, you've got total capital stock. Now we're going to have additional paid-in capital, additional paid-in capital preferred stock, additional paid-in capital common stock, and then we're going to have additional paid-in capital treasury stock. So we're going to have our total additional paid-in capital. The additional paid-in capital for the preferred was $760,000. For the common, it's $2,821,800. And then for the treasury stock, it's $1,500. So my total additional paid-in capital is $3,583,000. So over here, it's my total. What's interesting is they say total, basic total. So now we have total paid-in capital, par plus APIC. So we'll go over here and show this as this amount. And then we're going to add in our retained earnings. My retained earnings is 4,092. This is a reminder. The problem told us that the balance on June 30th was 690. So I didn't have, these are already going to be put into that number. So I didn't have to worry about those. Okay, so now we have total paid in capital plus retained earnings is going to be less treasury stock. And this is basically going to be at how many shares of treasury stock are out there. So this is going to be 1,500 shares at cost. Okay, so this is going to be a negative 58,500. So my total stockholders' equity is going to be 6,088,000. I'm just indenting just so you can see that when I'm putting things to the right, it just means I'm adding up the prior column. So if that annoys you, I apologize, but this number here means I'm adding up these two over here. Let's have it. Okay, so you would also have to disclose as well now over here, because we did not declare a dividend, you would want to disclose to the shareholders that you did not pay the dividend to the preferred shareholders. So you would say that in what the book uses is they basically say, well, Penn Company is in arrears on the preferred stock in the amount of 40,000. So I think that that's probably a pretty fair disclosure. So you would say something like in the footnotes to the financial statements, the company is in arrears on the preferred stock in the amount of $40,000. And the reason why is it hasn't gone through and declared its June 15th, 2021 dividend. So we want to show that to the reader that that's what's happening. Okay, so let me see if I messed up on anything else. Okay. I think that's it. So again, yeah, okay. So that's pretty much it for this particular question. I want to thank Wiley for allowing me to go through and to use their questions. Please don't forget to like and subscribe. If you're looking for other solutions, please feel free to ask for them in the comments. Have a great day, and I look forward to seeing you on the next video. Have a good one.